us. Now let's get to our Steve Leisman alongside Dallas Fed President Robert Kaplan. Steve, take it away.
Leslie, thanks very much. We are joined as part of our continuing Jackson Hole coverage by Robert Kaplan, the Dallas Fed President. Robert, thanks for joining us.
Good to see you, Steve.
You know, it isn't normal that we have the pleasure or the need to have a single president on twice in a couple weeks, but things are moving relatively fast right now. And I want to just get your sense right now of the outlook for policy. You know, you had been among those, the first really to call for an earlier taper as soon as September. And I want to know, amid the recent concern about the Delta virus and the Delta variant, do you still stand by that call?
Yeah, so we've spent, with this resurgence, we've spent the last week, 10 days, really redoubling our efforts to talk to contacts, do real-time surveys, looking at high-frequency data on mobility and engagement. And based on everything I'm seeing, I don't see anything at this point that would cause me to materially change my outlook. I'll continue to monitor this for the weeks leading up to the September meeting. But based on all that, it would continue to be my view that when we get to the September meeting, we'd be well served to announce a plan for adjusting purchases and begin to execute that plan in October or shortly thereafter.
Robert, tell us about those contacts you have. And you know, it's so interesting because the Dallas Fed is in such a diverse region. Used to think of it as only oil. That's not the case anymore. You've got high tech, you've got manufacturing, you've got energy. What are they saying to you about how the Delta variant is affecting the economy down there?
So we're seeing the impacts vary by industry. So if you're in the travel industry, it goes without saying, airlines, hotels are seeing some negative effects. But by and large, what we're hearing from contacts is they're weathering this resurgence at least as well as previous surges, and many are telling us that the impact on their business is more muted. So we're seeing resiliency, and I think the reason we're seeing that is because we have a much higher percentage of the population that's vaccinated, and we've got more tools at our disposal. And what we're seeing is consumers and businesses are just becoming more adaptable, more resilient, and I think people are accepting this is going to go in fits and starts. This may be not be the last resurgence we see, but people are using vaccines, masks, testing, and all of our tools to manage through it. So we're seeing resiliency.
You know, to that point, when we talked in August a year ago at the first virtual Jackson Hole Summit, it was amid a surge. Do you concur with what Fed Chair Powell has said, that we're sort of learning to live with it? And I understand that that comes with a lot of sort of loaded sense that, you know, that you don't care about the people who are getting sick, and we know that's not the case. But from an economic standpoint, does it seem to you like the economy is really learning to adjust and people are learning to adjust?
Yes, that is what we're seeing. Now, I spent a lot of time with hospital leaders, and they are in a very challenging situation right now. And I've been in meetings with mayors, county judges, along with hospital leaders, where they're urging community leaders to do more to use the tools we have. But certainly, what we're seeing is businesses and consumers are learning to adapt and go on with their lives. And they're realizing that this is not going to be neat and clean or a straight line. It's going to go in fits and starts, and they're getting adjusted to that reality.
Robert, what is your sense about how the $120 billion in asset purchases are impacting the economy? Are they helping? Is it keeping interest rates down? Is it making it more possible for people to invest? Or is it doing more harm than good in terms of driving up inflation?
Well, these purchases are designed primarily to stimulate demand. And that was very appropriate in 2020. It was appropriate in the early parts of 21 before we had vaccinations and widespread vaccinations. At this point, we don't have a demand problem. What I'm seeing is, yes, we're seeing shifts in the mix of demand in the economy, but we're seeing pretty strong resiliency of demand, and that continues to be our outlook. And we'll continue to monitor that. My concern is, along with that, we're seeing unintended side effects, excess risk taking, and particularly in the credit markets. You're seeing some distortions and excesses that I think are going to need to get normalized. We've talked about the housing market, and in particular, there's going to be a ripple effect from housing on rents and how those rents affect low, moderate income communities. So I'm concerned about the excesses and imbalances and unintended side effects. I think we'll be a lot healthier if we can soon wean off these purchases, and it'll put us in a lot better position going forward.
Robert, when you say credit markets, do you mean specifically things like high yield and the spreads there? Where else are you seeing sort of distortions in markets?
Listen, I have a markets background, and so I particularly start first look at credit spreads. Credit spreads are historically tight. In some cases, high yield credits have negative real yields. That I'm not sure is likely to be sustainable, and I think there'll need to be some adjustment. And I think the sooner we start that gradual adjustment process in the fixed income markets, I think we're well set up to adjust to it. I think we've communicated that a taper is coming, but I think we'll be healthier as we work through that adjustment.
Robert, your colleague Jim Bullard, who we had a chance to talk to this morning, laid out a very aggressive timeline for tapering. He wants it done by the first quarter of 2022. Is that your thinking? And then tell us your thinking about the pivot or potential pivot to rate hikes thereafter.
All right. So I'll take those in reverse order. I have explicitly, and I will continue to divorce considerations for asset purchases from our considerations on the Fed funds rate. The Fed funds rate is a decision that's going to be made down the road. Yes, my first rate hike and my forecast is in 2022, but I'm not making that decision today. We'll make that decision down the road. So I think that's a separate process. In terms of timing, I would prefer to start soon, but do this gradually. And gradually for me means plus or minus 8 months. I'm open-minded to other proposals, but I think we'd be well served from a risk management point of view to start soon, but to do it gradually.
Robert, what do you say to Americans, who are experiencing these high inflation rates right now? You meet them on the street and they say, President Kaplan, I have got prices going up at 5% a year. What are you guys doing over the Fed? How do you respond to average Americans on that score about the outlook for inflation, what you're going to do about it?
And I'm having a number of those conversations, and it reminds me, and you've heard me say this, we have a dual mandate, full employment and price stability. And even with our new framework, where we're letting inflation run moderately above 2%, we've got a commitment in that framework to anchor inflation at 2%. And what I'm seeing is low moderate income communities are expressing to me inclusive prosperity, inclusive growth is jobs and price stability. And what we're seeing in these communities is inflation affects them disproportionately. Gasoline, used cars, potentially higher rents take a greater share of their wallet. And so I think at the Fed, we've got to take that very seriously.
Robert Kaplan of the Dallas Fed, thanks for joining us. I'm sorry we don't have mountains in the background, but I guess this will have to do like everything else the past 14 months or so.
Yeah, thanks, Steve. See you soon.